Hey there, folks. Welcome to Broadband Deployment News. So Starry Internet, which last week announced that they were pulling out of the RDOF auction, has announced that they are planning on laying off half their workforce. Be right back. Hey, thanks for joining me. Rick Husey here with Broadband Deployment News. So, as I mentioned, Starry has announced that they are going to be laying off half their workforce, 500 employees. So this comes just about a week after they announced that they were going to be pulling out of the RDOF auction. That's the Rural Digital Opportunity Fund, where they had actually bid in this reverse auction and won. They were one of the top 10. I think they were like number 8 as far as the amount of money that they won. It was somewhere, I think, if I recall, around $260 million that they were going to get in support to help them broaden, to deploy broadband using their fixed wireless and I think some fiber, maybe some mixture of that and fiber. So they pulled out of that, I think, because things were not going well financially. So even getting that money with the way things are today with the economy, I think they decided that was not a good thing to be doing at that time. So they pulled out. I'm sure that was a tough decision, but I'm sure this is a tougher decision for them. So you can see here, Starry announces strong third quarter. So they're obviously going to spin this as best they can. So strong third quarter 2022 operational results, takes cost-cutting measures to conserve capital as it explores strategic options. So they mention here that they successfully delivered strong growth in customer relationships to bring that up to 91,297 subscribers, also increasing the number of homes serviceable to 5.96 million. So that's quite a few homes that they pass. Homes, a lot of them are in apartment buildings, but that's quite a few potential customers they have, but not much penetration, as you can see there. And then driving penetration of homes serviceable, so they did increase the penetration over that time. Starry also announced that its digital equity program, Starry Connect, now reaches more than 87,000 units of public and affordable housing, an 83% increase year over year. So they've been trying to make their service more affordable because a lot of the buildings that they serve would be able to receive benefits. So that's a good fit for them. The company also announced that it's implementing cost-cutting measures to conserve capital and improve its capital runway as it explores all strategic options. These measures include an approximately 50% reduction in its workforce. So again, it's about 500 folks. Freeze on hiring and non-essential expenditures. So not going to be hiring. A focus on penetrating its deployed network and deployed buildings where it has already invested capital. And it mentioned, as I mentioned, withdrawing from the FCC's RDOF program. So they're not planning on expanding at all, from what I can tell, into any new areas right now. Really what they're kind of doing is retrenching and planning on looking at their current business where they have customers that they can provide service to and trying to increase penetration there. And they certainly have the ability or lots of opportunity to do that, as we can see, where they pass a lot of homes, or I should say apartment buildings for the most part. Further, the company announced that in light of these measures, it's withdrawing its full year 2022 guidance. So in other words, they're not ready to say what the future holds. They don't want to put any commitments out there, I should say. Starry continues to execute well on our third quarter operating results, show it with our focus on increasing penetration and customer relationships in our dense urban markets with multi-tenant buildings. So that is primarily where they're focused, is in these urban markets. Said Chet Kanoja, Starry's chief executive officer. Even so, the aggressive measures we announced today were needed to curtail our cash burn while we pursue strategic options. So I think in their summer announcement, they said they had 100 million in cash, and but they had spent 90 million already at that, I think, in all of 2022 at that point. So they were really burning through a lot of cash. It says, today is a very tough day for our Starry team, but I want to be clear, Starry remains open for business. We, like so many others, are making the difficult calls now and taking steps that will allow us to be laser focused on financing the business over the long term and continue serving our markets. And then they mentioned some highlights here. So they talk about homes serviceable at the end of the third quarter. The homes serviceable were 5.96 million. So that increased 18% year over year. And they said that was due to network improvements and expansion in existing markets. Customer relationships, as of the end of the third quarter, those were 91,297, and that was an increase of 66% year over year, so that's a good increase. The net additions in the quarter were a record 10,347. Starry saw growth in customer relationships in each of its 6 markets during the quarter. Penetration of homes serviceable. Company increased penetration by 44 BPS year over year by 1.53%. I'm not sure what that is. Focusing on sales and marketing efforts primarily in multiple dwelling units again, where Starry equipment had previously been installed. So then they show the numbers here, so you can see 2022 versus 2021. But again, you can see that they've got lots of homes that are serviceable, but not a lot of customers at this point. So almost 6 million passed, so to speak, and 91,000 that they're servicing. Penetration of homes, you can see that's 1.53%. That has increased though since last year. And you can see the availability of the Starry Connect program increased quite a bit last year as well. That Starry Connect program, I had a couple of images here, I think, from that. Yeah, so again, these folks, they provide service in dense urban areas, as it says here, and they do provide service to a lot of buildings that would be, have federally assisted programs, in fact, maybe even owned by the federal government. So they're kind of right there all ready to be able to get benefits, like low-income kinds of benefits without having to go through a lot of paperwork because they're already kind of receiving that from the government. So you can see here, in order to qualify as a Starry Connect community, the property must fall within one of the categories. 90% plus of the units must be subsidized by federal, state, or local funding. Community is 100% owned by a public housing authority or other government entity. 100% of all units are either subsidized by federal, state, or local funding and or income limited, income thresholds, so as to qualify as regulated, affordable, or workforce housing in the local municipality. And 90% plus, I should say, or 90% plus units are rent controlled, rent stabilized, or participate in another state or city mandated affordable housing preservation program. So if a building meets one of these criteria, then people can participate in that. And what they get, basically, there's the Starry Connect tier, which is $15 a month, and that gives them a 30 by 30 connection. So that's a symmetrical connection at 30 by 30. And Starry uses, by the way, again, it's fixed wireless. They use 5G technology, and I believe it's licensed spectrum that they're using. So they own the spectrum, and they deliver it to the building, and they deliver it from it's something I was reading earlier, that they deliver it over the coax cable in a building, for example. So it said it was kind of a novel approach, but I think they're probably just using G.hn in the building. So in other words, that's where they can have their fixed wireless to the outside of the building, and then G.hn allows you to, and it doesn't matter what's coming into it, it allows you to deliver up to gigabit speeds to units within that apartment building over existing wiring. So you don't need to rewire the building, and that could be coax, that could be phone lines. So they may be targeting buildings that have coax. I think that might have the fastest speeds available if you can go over the existing coax. But you can see here they've got that plan. They've got the 100, let's see, Starry Select $30, and that's 100 by 50. And then they've got Starry Plus, that's $50 per month, and that's 200 by 100. And it mentions these tiers in pink are available and fully covered by the ACP program. So someone can get a subsidy for one of these if they want to do that. And if somebody's on the ACP, they'd want to go for this program because they can get, the benefit could be up to $30, and they'd be getting free internet 100 by 50 under that. And you can see here, this is something I think they do on all their plans, unlimited data. They provide the router, so there's no equipment fees, free installation, and they say no hidden fees, always one flat price. So they don't have a low price to get in, and then the price goes up after a certain period of time. So they've been successful, I believe, in unhooking subscribers in apartment buildings from cable, where they, again, they can get through the coax, they can either get the service that maybe an incumbent cable provider is providing, or they can get Starry through the same wire. So as I've mentioned before, if price is significantly different and people are willing to change, and it sounds like there's not that much of a hassle if you change to them, because you can get the service over the same wire, the coax cable, and they provide free router, no installation, those kinds of things. So again, they've got their plans here. This mentioned a couple of other plans that are available maybe in certain areas. So they got their $65 a month 500 by 250, and then $80 a month for their gigabit. That's a gig down and 500 megups. So they've got great speeds. I think their latency is good as well. So this is a service that people are going to want. The question is, why are they having issues? Now, they went public. It was not good timing to go public. So they went public at the end of March. And is this June? No, I'm sorry. Yeah, no, it was the end of, I think that's right. Maybe it was June. I'm thinking, oh, here, I can tell from here. I got there. Let's see. So this is, this is it here. So here it is here. Yeah, they went March 29th. They went public. So they went public March 29th. This was the S&P chart. So this is March 29th. So I'm wondering if they were looking at the markets and, things were going down, and then it looked like things were ticking back up again. Maybe things were looking up, some COVID recovery and whatnot, looking up. And then we hit March 29th, and then boom, bottom falls out of the market again. And that is when they went public. So they immediately out of the gate started losing a little bit there, but then they ticked back up again. They were doing well. And then this date, things just kind of fell off here, and it's been going down since. So you see they were up at this point to about 1051. Actually, if you look at their 52-week high was 1090, and they got down to, I think, 82 cents today. They're now at 85 the last time I looked at this. So they're under $1. So that's kind of danger zone. They need to get that back up. If you're under $1 for, I think it's a month with the exchange, then they could potentially get delisted. But with everything that they're doing, hopefully the measures that they're taking, a lot of times when companies do this, there's a little hit, but then their prospects look better as people realize they're going to stop burning through cash, and they're going to focus on their core business, and people may start buying that. Stock price goes back up. So hopefully they can get that stock price back up over $1. And that won't be an issue because they're just in the early throes of that. In fact, here, they were down to just under $1 right here. And then right around here is when they announced that they were pulling out of RDOF. So again, about a week ago. And it looks like they kind of bumped back up again. But then the announcement with the layoffs, and you've got the reaction to that. So again, maybe some investors will realize after a few days, hey, this looks like they're doing what they need to be doing to get their business back in shape, and stock price could go back up. So we can just watch that, see what happens. Again, this is what we were looking at with this is the S&P 500. So again, it's been just on a general trend down. We did have things going back up again here up to August again, but then it's dropped back down. Things are looking a little better today, last time I looked, but the stock market's generally been falling as inflation's been pretty rampant lately, and people are concerned about that. So again, not the best timing to go public. It's one of those things that happens. It looked like it was going in the right direction, and then bam, just did not. So that may have impacted things. What did I have here? So interestingly enough, so let me go back to the date that I'm sure this is just a coincidence, but so the date that their stock tanked, was between, this was the Friday, June 3rd, and then on June 6th, so it went from 1061 to 761, and then kind of free fall pretty much from there, a little bit of some ups and downs, but I just happened to notice, I was looking if anything happened around that time, but the only thing that happened was I saw this story come out. I was looking in the news, and this was basically that Monday that this came out. No, it was a Friday. Was it June 6th? Friday. Anyway, so it was right at that time frame. So I think it's just a coincidence. I looked at the story. I couldn't see anything that would have triggered that, but just a coincidence. So, and this was a story where the CEO was saying customers couldn't give two hoots about ILEC fiber, but rural fiber differs. So it says here, incumbent providers nationwide may be accelerating their fiber deployment plans, but Chet Kanoja, CEO of fixed wireless provider Starry, said Friday that customers couldn't give two hoots about fiber. Starry emerged a few years ago as a fixed wireless provider targeting large multi-dwelling units and has had considerable success in that market, averaging 25% take rates within the first year when the company aims to reach payback on its investment. So I'm not sure what they're talking about the 25% take rates there, unless they're talking about maybe buildings that they've approached. But obviously we could see the number of customers that have access to their service versus the number that actually take it is more like 1% or something, whatever that number was, a little over 1%. So I'm not sure what that's talking about. The company develops its own technology, which is rather different from that of other fixed wireless providers, and then it can use coax distribution infrastructure within a building to distribute service. That's where I read it. So I did pull this article up. So again, G.HN technology or GHN technology allows anybody to use the coax in a building. So I don't know if it's their technology or if they've done something to make that a little bit easier. But in general, G.HN allows somebody to use coax cable within a building, or phone cable for that matter, in a building. Not surprisingly, 65% of customers cut their cable service to go to Starry. So I suspect, again, that could be related to cost, if it's a lot less expensive for them to do that. He says here, if customers are getting speed, performance, and price, they're indifferent to the technology, Kanoja said. And I think that's true. I've mentioned that. It's, fiber is great if you can get fiber, but it's somebody, for them to want to quit, the performance needs to be poor, or whether that's speed, if the speed's not really up to par, or internet's not reliable, those kinds of things, or price. Those are the kinds of reasons that people will quit. But in general, if things are going well and they're happy with their internet, it's hard to get them to switch. Kanoja also does not see fixed wireless offerings from Verizon and T-Mobile as competition. The reason is that those companies are offering service where they have excess capacity on their mobile networks. They typically have little or no excess capacity in the large urban areas that Starry targets. And I don't know how true that is. I mean, I think here in Atlanta, I've gotten, depends on how urban it is, I've gotten texts from T-Mobile at first trying to get me to switch over from what I have now, which is AT&T. I don't know if it's, I haven't checked to see if it is available. Coworker of mine is in a different location, but also in the North Atlanta area, and he did get it. He decided to go that route. He had, I think, Xfinity before. So I think T-Mobile, I was thinking about why they would have pulled out of RDOF, and there's a couple of different reasons. Obviously, it mentioned about them being kind of strapped for cash. So even though they were going to be getting cash from the RDOF, that split out over 10 years. So the amount of money that they were awarded would be over a 10-year period. So they only get to use a tenth of that, or collect a tenth of that each year. So that's significant. Also, with the inflation rate that's taken over since they first got into this, then that has really increased the amount that it would cost to borrow money. So if they were going to get more funds, that was going to be costing them a lot more money. So that could be one reason. But then I was also thinking about the fact that T-Mobile and Verizon and AT&T, are also doing 5G in wide areas now with mid-band spectrum. Starry, I think, is using more millimeter wave technology, so they can offer these plans in some areas that are gig speeds. But if T-Mobile comes in at speeds that are well over 100 megabits per second, then again, people may not care about a gig if they can get T-Mobile. Now, pricing-wise, Starry was actually doing pretty well, so they look like they could compete with that. But again, that's just one more competitor that they had to deal with. Mentions here RDOF and rural fiber. So this is all before, this is before Starry learned that they were going to be getting RDOF funds, and obviously before they pulled out of that, decided they didn't want to do it, which was just last week. Starry's target markets will broaden if the company is authorized to receive $268 million that was tentatively awarded in the RDOF auction, but the markets that the company is targeting for RDOF bills aren't as rural as some other RDOF areas, they say. So Starry focused our RDOF efforts on perimeters and bleed-over areas from where we already had licenses, he said. Now, they must have been talking about areas they had licenses but were not yet servicing, because when I looked at the states that they were servicing today, and the states where they won RDOF funds, there really wasn't an overlap there. So they must have had licenses in other states that they were planning on using these RDOF funds to expand. As an example might be a new and as yet unserved development or mobile home park lacking service. Well, that's not the way RDOF works. So if you bid in census blocks for RDOF funds, you couldn't just say, okay, well, I'm going to deliver to this municipality, or not municipality. I'm not going to deliver just to this MDU, this multi-dwelling unit, and this trailer park, what do they call it? It's mobile home parks. I don't want to call it trailer park. Mobile home park or MDU kind of building, you had to deliver to everybody. So if you're going to get these funds, you had to make the service available to everybody. So you could not cherry pick in that area. I'm assuming they knew that when they got into this, but that was something that, they'd be competing with anybody else that was in that census block. They could not just say, we're going to deliver to the kinds of customers that we deliver to in our other territories. Certain parts of the company's bid were for super rural areas where the company will offer a much more fiber-like solution. He didn't elaborate on what that solution might be, but he did note that Starry's newest technology is designed to cover smaller MDUs and that the company is also conducting a trial involving single-family homes in Columbus. Well, again, if they bid on these census blocks, if there were any single-family homes in that census block, they had to deliver their service to those homes, anything that could get service in that area, in addition to any new developments that came up. So again, during that 10 years that they're getting support, if a new neighborhood is built, anybody that gets RDOF funds then has to provide service to that new neighborhood, or at least has to make sure that it's available to that new neighborhood. Ironically, he noted the historical view was that fixed wireless was fine for rural wireless, but moving forward, he argued that rural parts of the world will have way more fiber. This will occur in part because government subsidies and in part because some of the companies that are deploying fiber in rural areas, such as electric cooperatives, have very long-term payback goals in the range of 30 to 40 years. That's true. So, this is Chet, and if his name is familiar, maybe it's not, but maybe his previous company is familiar to you. He actually, in 2012, the first company he started, I don't know if it's the first company, but he started a company called Aereo in 2012, which you may have heard of, because what they were doing, Aereo, was that they had, I guess it was like these warehouses, and they had a bunch of little TV antennas in there, basically, and they would lease you a TV antenna and a piece of a DVR, like a TV antenna, DVR kind of unit, and you could buy from them access to your local stations in your area, broadcast stations, anything that was broadcast over the air, so like ABC, CBS, NBC, Fox, all of those things, they could provide that as if you were getting it. So basically, we're taking that signal over the air. You had your own little antenna. That's kind of how they got around what the thought would get around the fact that they were providing this to you. It would be like you had your own antenna and weren't pulling that off the air. But what they were saying was, well, we'll give you your own antenna. We'll just put it in this warehouse and lease it to you. So they were doing that, and they charged, I think it was $8 a month to do that. And the broadcasters did not like that because cable companies are supposed to pay retrans fees in order to be able to do that. So when you get your local TV internet from your cable company over your cable connection, the cable company is having to pay the local broadcasters and the broadcasters themselves, I think local and national, retrans fees in order to be able to take that signal out of the air and then retransmit it to you. Well, what this was doing was it was cutting the broadcaster's revenue because suddenly he was taking that signal out of the air, taking $8 a month and not paying the broadcasters anything. If people cut, that people were saying that it was causing people to cut the cord because suddenly they didn't have to worry about keeping their cable connection because it's like, well, I'm going to keep my cable connection so I get my local TV channels. I don't want to get up on the roof and put up an antenna or I'm too far away to get a good signal with an antenna. So suddenly they have access to local channels through the internet. And I think it was even on Roku towards the end there, where you could get it on Roku and just click on there and pull up Aereo and watch your local broadcast stations. So the broadcasters were losing revenue, and they were saying people were cutting the cord, so people could cut the cord and they could stream maybe some things from Netflix, whatever the streaming services were available way back when in 2012. And they could still get their local TV channels through Aereo, and they'd pay them $8 a month to do that. Well, broadcasters didn't like it, went to court, went all the way to the Supreme Court, and the Supreme Court, I think it was 6-3, said, yeah, no, you can't do that. So that was like 2014, maybe April 2014, I think it was, and Aereo at that point said, okay, we give up, and they filed for Chapter 11. Eventually they were picked up for some reason. I don't know what TiVo did with it, but TiVo bought the service for like $1 million at that point. Not sure if they're still doing anything with it, but it did have a DVR component, so maybe TiVo thought they could use the technology or maybe market to the customers. I'm not sure what they were doing, why they bought that, but so that's how he got started. But then, this other company, Starry Internet, he started that, and Now they're dealing with some challenges, but hopefully no issues related to keeping the business going. So again, if they can kind of get their act together, they're regrouping, they can look at focusing on their current markets, getting their revenues up, and since they're focusing on the current markets, they're going to have low capital expenditures as far as they're not having to expand into new areas and worry about towers and those kinds of things. They've just basically got CPE. So each new customer, they're going to have to, they're providing the CPE for free, but hopefully they'll provide good service. And over time, that will give them, revenue over time. So anytime you get a new customer, it's going to take a while before they're profitable. And if you're giving the equipment especially, so hopefully they'll be focusing on customer service, those kinds of things. And again, if the market sees that this is something that is going to continue to be a good business model for them, then they'll hopefully reward them. They'll get their stock price up, and they can look at expanding in the future. So hopefully that will go well for them. Chris says, hold on a second here. Chris says, don't forget they have to pay $38 million. Yes, I didn't know how much it was. I knew it was going to be a lot. It's like $3,000 per census block if you default on your RDOF. So they've got that. So that was probably a tough decision. You say 15% of the support total, one per RDOF rules. That's true. So $3,000 per census block, and then the FCC kind of limits that down to 15% of your support. So it looks like Chris has done his math there and got that, 3,000 per block capped at 15% of total winnings, exactly. So I'm sure that was playing in their decision here. It's like, well, do we take this money? If we take the money, then we are committed for 10 years to be building out all of this infrastructure in all of these areas. And again, they've got to cover every single bit of that census block. They can't cherry pick. They got to cover it all in all these areas that they had won. And again, they're only getting 1/10 of that money each year. Or do we take the hit and say we're not going to do it? And I think they decided in the long run it was better to take the hit and kind of retrench now and then get their business operating back to where where it's profitable and maybe stop burning through all that cash. So this will help them do that, obviously, because they're not going to be doing an expansion. They're going to be primarily, well, they've hopefully got some money to pay off that fine or those defaults, and then they can move on from there. So great comment, Chris. Thanks for watching. Thanks everybody else for watching. If this was interesting or helpful, go ahead and give me a like on the video if you would. And if you're not subscribed, click the subscribe button and click the little bell and you'll be notified when I'm live. Thanks a lot, and I will see you next time for Broadband Deployment News. Take care.